So in this video, we are going to create two spreadsheets. One is called the stressless trading method itself, and the second is extra cash. We're going to try to create two separate spreadsheets. Firstly, we'll talk about the stressless trading method. Of course, stressless trading method is a very price-based method. It does not take into consideration the time of the trades at all. It is just dependent on what the current price is. For example, it will start off by taking a price of, say there's a stock I found whose price is $50, right? And I have cash of 100,000 to spend. I have a cash of 100,000. And the price at which I want to start is $50, right? And initially we end up, although this is flexible, but for the current simulation, I will just say that we start off by using 50% of our money to buy some shares. So we have shares bought. We to So we'll spend we'll buy 1,000 shares, and we will end up spending $50,000 to do that. So we will end up spending. So our cash gain will become F3 multiplied by G3. Negative of that because we are spending the money. So now our cash gain, which is basically this opposite of cost, is equal to minus $50,000, right? So just to keep our numbers making sense, I'll just choose a better format for it so that it now reflects $50,000, right? So now there are two possibilities. Either the stock will go and hit 51 or it will hit 49, right? Suppose it hits 49 next. Then at that point, we will buy another, let's say 10 shares. We will have a constant number in our mind and we'll buy that number of shares. So of course, when we buy 10 more shares, we will end up spending some money, the $490, right? Now, after that, the price can again either go up or down. Suppose it goes down and hits 48. So we are taking increments of $1 and working with those increments. So it could drop to 48. When it drops to 48, we would again buy another 10 shares. We are following the same strategy. We are working with a number of shares at every trade being equal to 10 for right now. So now it will become 48. So now we can continue with this strategy, or like if the price just keeps dropping steadily, right? If the price keeps dropping steadily, we can continue to keep buying 10 shares. So what are we actually doing? We have a concept of step size, and that step size is nothing but the difference between the current price and the previous price. So I can just take that to be uh, F4 minus F5, F3. If I do that, now my price has actually gone down by $1. We can keep track of that $1 here. And if now I will just so this is what is happening as the price drops by $1. I keep buying 10 shares every time. And so the other way to think about it is I could have a situation where the price is rising by $1, 51, and now I would be selling 10 shares. And now this process could continue also, just like the previous process. And I could have my prices rising, and as the price rises, I could end up keep selling 10 shares, right? So the whole purpose of buying these initial 1,000 shares is to make sure I have enough shares to sell as the price rises. So I'm doing two things. I'm using some of my money to buy some shares to make sure I have shares to sell if the price rises. And I'm keeping some of my cash to buy more shares if the price falls. That is the underlying strategy. At every price point, you should have some cash to keep buying more shares, and you should have some shares that you can sell at higher prices, right? If you
We will
follow this
balance,
strategy, go
so
ahead.
we will balance both our cash as a number of shares so that we're able to interact and execute in the marketplace, regardless of whether shares go up or down in price.
Exactly, exactly. And for this simulation, I have distributed it 50-50, but depending upon what your understanding of the market is, that distribution could be different. But for this video, we will assume it is 50-50 for right now.
Understood.
So as you can notice, there's a few parameters that need to be set to build the strategy. One is the amount of cash that you use to buy your initial shares. So this becomes one parameter. I'll just highlight the ones that look like
Yep.
parameters. This is one parameter. This whole column is one parameter. Usually we just set it up as one constant and just work with that constant as the price rises or falls. And pretty much if once you've set these two parameters, and the third parameter is of course this parameter where you are setting how many shares you are buying or selling every time the price drops. So once you have set up these three parameters, your strategy is set and you are ready to execute the strategy. That's as simple as the strategy is. As long as you can select these three numbers, you are ready to go. Okay. So that is the strategy part. Now I want to come to explaining why doesn't Dynamics keeps talking about extra cash. So coming back to the same strategy,
And
I'm going to start off.
before we start, Pratik, we will work with the customer to help set those parameters, correct? We're not choosing the stock for them. We're not dictating, in a sense, that ladder or those other variables, but rather our onboarding specialist working with the customer to work through both the choice of stocks or ETFs, as well as the three parameters that you've outlined here.
I mean, the app is designed to help you take care of all this. It is not
Understood.
like you have to talk to a customer service specialist to set these parameters. The app will help you design all this. And of course, a customer service specialist is available in case you get stuck, because definitely don't
Right.
want you to be having a strategy that you do not understand or do not want to execute. But
Excellent.
once you get the hang of it, you can set these up yourself. It is as easy as setting up a trade. When
Yep.
you are setting up a trade, anyway, you have to set up the number of stocks you want to buy, the price you want to buy them at, and how much cash you want to use. So anyway, those three parameters get set in a normal trade anyway. So the task of setting these parameters up is not more complex than setting up a trade in a regular
Yep.
with a regular broker. So,
Yep. Quite simple. Yes.
yeah. Okay. So now coming back to what is the impact of this strategy, right? So let us say again, coming back to the same model, we have a cash of $100,000. $100,000, and we have found a stock whose price is $50, right? And now, just like I talked about initially, we will have shares that we will be buying right away. And let's say that is 1,000 to make sure that 50% of our money is going towards buying shares. So now our cash gain, again, just like we calculated last time, cash gain will be equal to minus EC multiplied by X. So we'll end up spending $50,000. Again, for sanity, let us make sure everything is as visual as possible. So, this $50,000 has been spent. So now we can calculate our cash left, which is nothing but our initial cash, which we started from, which is D2, D2, at least D2, D2 plus plus G3. So now I have $50,000 left in my account. Shares owned is equal to my initial buy, which is F3. So now I own 1,000 shares. And let me just get some formatting done properly for myself. Okay. So we got our columns right. And this is what's going on. Now, immediately the question becomes, what is my account value? After performing every trade, I have an account value. And my account value is nothing but the cash I already have in my account, which is H3, plus the value of the shares I own, which is now I3 multiplied by current price, which is E3. So I got my account value to be $100,000. Cells. Number. Okay. So my account value is $100,000. Now we already know the strategy pretty well. What we are doing is every time the price goes up by $1, we are going to sell certain number of shares. And when it drops by $1, we are going to buy a certain number. So let's just decide what that number of shares is. So shares bought or sold per trade. Per trade. Let us say that is 10. If it is 10, then essentially what will happen? What will happen is, okay, here, okay. So the next step will be that process 49. Suppose the price, like I was discussing, let's say the price drops to 49, 48, 47, 46, 45. Let's see the price keeps dropping like that, right? Our strategy is to buy 10 shares every time the price drops. So let's say that is E. So that will be equal to E. Since we are buying, it will be equal to E3 minus E4 multiplied by A. Okay. So 10 shares every time. So what is the impact of buying 10 shares every time? We already know that. We know that that is going to be, our cash is going to go down by $490, right? So now we can stretch this part definitely. So now we have built our strategy. Every time the price goes down by $1, we buy 10 shares. What will be the impact of this process? The impact will be that your cash left is going to decrease as you're spending money. It is becoming H3 plus G4. So your cash reserve is now going down and your shares owned is going to go up, which is going to become I3 plus plus F4. So your number of shares is increasing and of course, since the price is dropping, you can see the impact of that on your account. Your account value is decreasing as the price is falling because now you own more shares, but the value of the shares is at a lower and lower price. So essentially, you start feeling like you're losing some money at least on paper, even though you've not sold your stocks, you're losing some money, right? So now the question becomes: we are following this strategy and we plan to use the strategy. The stock price can never fall all the way below zero. So we want to make sure that we have enough cash in our account to implement this strategy all the way down to zero, right? So keeping that in mind, I want to calculate how many. stocks will I end up buying if the price drops all the way down to zero? Stocks to be bought in future, right? So when the price is 50, and since I'm buying it every time the price drops by $1, there'll be essentially 50 trades I'll be placing in the future, and those trades will be placed, and each trade will get me to own 10 more shares. So effectively, the number of shares I will buy in the future is equal to the current price, which is E3, multiplied by the shares I buy every time, which is $, right? So the shares so I'm buying my initial 1,000 shares, and I'm setting up my strategy so that in the future I'll end up needing to buy another 400, 500 shares after make my initial purchase. And as the price keeps dropping, I'm every time I'm buying 10 more shares. So basically, what is happening is I bought 10 more shares, and so now I have 10 less shares to buy in the future. My number of shares to buy in the future is reducing as I'm buying more and more shares as the price is going down, right? So
Correct.
shares to be bought in the future is now very clear as to how many shares I need to buy in the future as the price drops. Now the only question left is what is the average, the future mean purchase price of these shares, right? So since I'm buying shares all the way down from 50 to 0, I don't need to actually add up all my prices at which I bought and then divide it by the number of trades. All I need to do is take the half of the current price, and that will be my average, my future mean purchase price. So essentially, that will be E2, E3 divided by 2. It is as simple as that. I don't need to make a very mathematical computation to get to this average, the future mean purchase price. And again,
It's,
this is a future, this is my average purchase, my future mean purchase price for my future trades that I'm going to carry out. It has nothing to do with trades I've already performed. So this is not like most trading strategies talk about average purchase price. This is the future purchase price that I've calculated for my future trades, provided the stock price is continuously going down, right? We just want to be fully competent to buy shares provided the stock price just keeps continuously dipping. Right? So if we follow this approach, we will find that our future mean purchase price keeps reducing as the price keeps dropping and this is only because we are we are making an entirely different calculation that we are making in row number 3 versus row number 4. In row number 4, we are planning for making purchases when the price is at 49 and going all the way down to 0. In row number 3, we are making all these purchases so that we are at the starting point is 50. So it is really not that we are calculating the average of trades we've already performed. This is the average purchase price of my future trades. It's very different from a moving average that is usually calculated using trades I've already performed. So using these two, I can calculate something called cash needed. How much cash do I need in the future? That cash that I need in the future is nothing but a product of column K and column 3. So that is just K3 multiplied by L3. That's going to be 1250 here. Now the question is, this is saying I need 12,500 shares to make these purchases, right? But I have 50,000 in my account. My cash left is 50,000. So there's no need for me to restrict myself to 10 trades. This number is just a function of K3 and L3. K3 is the number of stocks I want to buy and average purchase price. Average purchase price is not going to change if I change the number of stocks I buy because the average purchase price story remains the same. It is distributed equally between the different prices that I'm buying at, right? So the only thing I need to change is my number of shares bought. And if I, instead of 10, I made it 40, let's say, then suddenly my cash needed becomes the same as my cash left,
Correct.
right? And now I can calculate my cash needed as the price drops just by taking a product of these two columns. So as you can see, my cash needed can be calculated very easily. Extra cash is the cash that is sitting in my account that I don't need to perform these trades. That extra cash is nothing but the difference between cash left in my account, which is cash left in my account is column H. So that is just H3 minus the cash that I need, which is M3. When I start off, my cash needed is zero. My extra cash is zero because my cash needed is balances with my cash left. But as the price goes down, you will observe that my extra cash steadily rises, right? So it steadily rises. So it is natural. I mean, the price has dropped and my extra cash is steadily rising. Now, just for doing a sanity check, I will also calculate my profit. My profit is nothing but my difference between my current account value, which is J3, and the total cash I started with, which is $2. So initially my profit is zero, but as the price drops, as expected, my profit keeps sliding down. Right. So the first interesting observation is the price is dropping, profit is dropping. That is the lesson we have learned all our life in trading. Nothing too exciting about that. But the extra cash is rising, right? So essentially, somehow for some reason, extra cash is rising and my profit is dropping as the price drops. So it is natural for us to expect that now if the price starts rising, instead of dropping, let's say the price starts rising. And it goes all the way down to 50. It goes all the way back up to 50, right? If we follow the same strategy again, we can calculate what will happen to our account value. We just need to stretch these columns. So the entire story has been built. Now, we don't have to do anything new. Again, just for visuals, I will change the format here. And now you can see there were some trades where I was buying shares and then there were some trades where I'm selling shares, right? So now as the price is rising, the stocks to buy bought in the future will start rising. And at the same price, at the price of 50, we will notice that the shares I have to buy in the future is exactly the same as the shares I have to buy in the future at 50, right? I can now also calculate the cash that I need as the price is rising, right? As we can anticipate the profit itself, our account will start recovering as the price is rising. When the price is back to 50, our account would have recovered. We would actually end up having a profit of $400, right? But the real interesting part is what happens to extra cash. We would anticipate that because earlier the price was falling and this extra cash was rising, this time when the rises, the extra cash would start dropping. But actually, what happens is extra cash also starts rising. So this is where it gets interesting because your extra cash is rising no matter whether the stock price is falling or rising, right? So this is what makes this entire process interesting. And this extra cash is the cash at the price of 50. You will even notice that the extra cash is the same as the profit. So at this point, you can withdraw that $200. I mean, you can withdraw the extra cash at any point, depending upon the number of where you are in the process. You don't have to worry about the fact that the price is too low or too high. And your at certain price points, you will notice that the extra cash becomes exactly the same as profit. So as long as you're calculating extra cash, you're always aware of how much cash you can withdraw from your account without negatively impacting your account. For example, if I now stretch this process even further and go to 55 and I just extend these cells, you will notice that at the price of 55, your profit now is 4,800, but your extra cash is just $300, right? So you will say, hey, I made a profit of 4,800. Why can't I withdraw that money right away? And the reason you can't withdraw that money is because you need, since the price is higher, you need more money to keep buying when the price drops. So essentially, the withdrawable cash is just $300. So extra cash not only gives you the leverage to withdraw money when the price is dropping, it also makes sure that you don't over withdraw when the price is rising. It is a metric that makes sure that you are staying, your account is staying, to use a common phrase used in USA, your account is staying kosher whether the price is dropping or rising. So this is the value proposition that Doesn't Diamonds provides. It helps you keep your account in check by giving you an idea of how much cash you should be withdrawing from your account at every trade. And the other interesting part, of course, is that extra cash is continuously rising. So here is a metric that makes sure that with every trade, there is some metric that is continuously rising. Now, the benefit of that is that here I performed 15 trades and I ended up with extra cash of $300. With every trade, I'm getting $20. So if I perform 50 trades in a month, I will end up having $1,000 in extra cash. $1,000 is exactly 1% of my initial investment. So essentially, I can withdraw 1% of the cash that I invested every month, provided there are 50 trades occurring. And depending upon the volatility, that number can fluctuate. There are stocks where I have performed even 100 trades or 150 trades in a month. And if that happens, your extra cash in a month could be $3,000. But for right now, let us assume it is the safe bet is you perform 50 trades using this method because the price will fluctuate. And because of that, you will end up having another $1,000 that you can withdraw from your account. If you keep doing that for 100 months, you would have withdrawn all your initial capital, but the game would still be on. You would have $100,000 of cash that you have withdrawn, but you would still have your account will still be tradable because there'll still be stocks in your account, there'll still be cash in your account. And so in effect, in that period, you will be playing with house money. We have run simulations with stocks, with all the stocks. There's about 6,000, 7,000 stocks on which we have run the simulation. And we have realized that at least for one third of the stocks, your break-even point, or the point by which you would have withdrawn all your initial investment, could vary anywhere between 2 to 6 years. So that becomes a very valuable proposition. If it can happen to you in 2 years, there's nothing like that. 50% of your cash will be withdrawn from your account within a year, and the strategy is still going on. If it happens to you in 6 years, well, even that is not a bad proposition because you are basically withdrawing about 15% of your cash every month. So either way, this becomes a valuable proposition, and it also gives you a supplemental income that you are always looking from the stock market. Of course, it is always fascinating for people how extra cash is totally different from profit. And it basically provides you a different performance metric to assess your portfolio. Your portfolio does not have to be focused on always calculating the profit that your account is generating. Extra cash gives you a totally different metric of evaluating your performance. And so now you begin to understand that it is not just about making profits, it's also about making sure that there are other performance metrics that are also being that can also be used to assess how far you are in your trading journey. Thanks a lot, Kelly.
Thank you, Pratik.
Yeah. So I think that came out well.
I did too. I thought you did a great job. And I thought splitting it between sort of what we would call the overview of the stress test trading method and then getting into the spreadsheet, I think is very helpful.
Right.
Because it introduces kind of what actions we would take. And then I thought it was very clear in terms of the generation of extra cash is independent of your quote profit or P&L of your account. Um, and that's a huge differentiator on our part.
All right. Cool.
Okay.
Talk to you soon, Kelly. Yeah.
Yeah. Thanks, Pratik. Well done.
Yeah.